What it really means, I guess, in one sentence, is you're challenging inertia, Jason. Just like
I like
with
it.
any oligopoly that you're trying to shake up, um, this one where switching insurers seems very risky and seems unnecessary. We're challenging inertia. We have to show employers like a fast, simple, and more accountable option they can trust. And often it's just challenging that inertia and thinking.
Welcome to Frank Growth. I'm Jason Shafton, and I run growth consulting firm Winston Francois. Around here, we tell the truth about growing, the good, the bad, and the can't say it out loud ugly. Every episode, we get tactical with operators, investors, and builders about what works, what breaks, and what to do next. No fluff, no vanity metrics, no hustle theater, just signal. This is Frank Growth. Let's get into it. All right, today we have Jacob Batist. He is going to talk to us about breaking into a market that hasn't changed in 70 years. Before we bring Jacob on, a quick riff on today's topic. Canada's health insurance market is a silent oligopoly. I didn't know this until I was researching with the team for the show. There are 3 companies that basically control 80% of all policies that are written in Canada. There hasn't been a new entrant in nearly 70 years, and that's not really a market, it's a fortress. And then a European challenger worth nearly 5 billion euros walks in and says, we're going to go do this differently. Here are 3 things that make this story relevant for every founder and growth team. Oligopolies look unbeatable until someone reframes the value prop. Allen isn't selling cheaper insurance. They're selling preventative health that reduces claims. Different game. Trust is the moat in regulated markets. You can't brute force it with ad spend or growth hacks. You earn it through licensing, local presence, and proof points. Going slow is a strategy, not a weakness. When the product isn't fully mature and the brand is unknown, a warm first approach protects credibility while you build. That's the frame we'll use today with Jacob. Let's get tactical. Jacob, welcome to Frank Growth.
Thank you so much for having me.
I'm really glad you're here. You're head of growth at Allen in Canada, which is the first new health insurance company to launch in the country in like 70 years. You came out after I reached out, and in the moment I saw your background and what Allen was doing, I knew this conversation was something our audience definitely needed to hear. Before we kind of get tactical, please set the stage for us. In one sentence, what does it mean to launch a health insurance company in a country that hasn't had a new one since 1957?
What it really means, I guess, in one sentence, is you're challenging inertia, Jason. Just
I,
like
I like
with
it.
any oligopoly that you're trying to shake up, um, this one where switching insurers seems very risky and seems unnecessary. We're challenging inertia. We have to show employers like a fast, simple, and more accountable option they can trust. And often it's just challenging that inertia and thinking.
I love the idea of challenging inertia, and I'm like such a dumb American. I assumed wrongly that countries that have relatively socialized medicine, like Canada, that it was like, oh no, it's the government is the insurance company. That's not correct. As I was researching you and Alan and what you're building, there are basically 2 other players in the market, right?
So right now, there's about 3 or 4 companies that hold
Yeah.
about 80% of the policies,
But in
and
any
they're
given part of Canada and in like any province, there's only like 1 or 2, right?
yeah. In terms of like the actual healthcare system, primary care and emergency care are covered. If you need to see a physician for a specialist, that's covered. But in terms of drug, dental, vision, the paramedicals, like that, all needs to be covered by insurance. And those insurers, the insurance market right now is quite consolidated, as is many parts of our market here in Canada.
Something you said to me in our conversation preparing to have this interview really stuck out, which was you described Alan as like the neobank of insurance, which very much resonated with me as a strong positioning line. I have worked with many neobanks over the years. I've always favored kind of startups over the big banks here in the States, which, has bit me many times. But I'm curious, as you think about what makes you the neobank of insurance, what does that mean for an employer and for somebody in Canada who's looking for healthcare coverage?
As kind of, markety as that language is of being the neobank of insurance, how does that manifest? Well, it's building an insurance solution like a software, not like paperwork. So when you think about neobanks, what do? They make it really simple, really smooth, really good UX, very quick to be able to get stuff done. And that's the ethos that goes behind what we're trying to do here at Allen. Like you can sign up for insurance in minutes. You can get your employees covered same day. It doesn't take weeks to do it. You can have claims processed in as little as 15 minutes, not hours or weeks or months. We have one platform instead of multiple vendors to be able to offer core benefits coverage, to be able to offer health services like mental health clinic, and as well as preventative measures like step counters, meditation, exercises. We see it, traditionally like employees will submit a claim. They don't know if it will take 2 days or 2 months. They're out of pocket. That really shouldn't exist anymore, nor should the kind of mental load exist on a business or founder that is on the side of their desk trying to just make sure that they can offer the best benefits coverage to their employees, that they're going to be bogged down by administrative burden. I think that the goal of insurance shouldn't just be to pay claims. It should be to give people a safety net and to find a way to make it super easy and simple to do that.
I really like that language, the idea of simplicity and, making things easy. You often don't feel that way when you're interacting with any healthcare system. Before we started, you were talking about we were talking about how Allen is, order of magnitude better than the other options on the market. But that challenging inertia thing just keeps coming back and playing in my head because it's like, but this is what I've always had and it's easy and I don't know and this is new and I'm not sure. And so, starting out with the neobank positioning is strong, but then we have to back that up and the product has to sing and people need to just go and tell everybody else about it and it has to be awesome, right? So let's go inside the launch. What surprised you about entering the Canadian market? Obviously you're from there, but the company is not. What was easier than expected, and where did you hit walls that you didn't see coming?
Let's start with the good. The good part, which is probably the most encouraging part of this whole thing for us here in Canada and Allen in Canada, is that there is an appetite for change, Jason, like especially amongst businesses that are finding this friction, that are interested in employee, you know, health and well-being. They are empowered, people leaders. And a lot of people know the system is slow. They just assumed it couldn't be different. So there is this appetite for change, which is really that I would say that's like the really nice, propeller forward for us, especially when they see the product live. Like when our team does demos, when we have events and we showcase what can be done, the reaction is very immediate, which is really exciting. The harder part is really to us about, where and how these decisions get made. For us, the biggest benefactor of this is going to be either a founder or an HR people leader somewhere in that kind of realm of the business. But with any kind of business purchase, those decisions are not solely saddled with them. They need financial buyers, they need operational buyers. You're giving information. You're trying to have an empowered people leader, an empowered founder of people at their company. You want them to move off something that works and move them to not just something that is not broken, but is also not super brand aware. Like we don't have a ton of brand awareness. I mean, when you're competing against three companies that have been around for 250 years, the brand awareness just isn't there yet. And we feel that. So it's a trust thing that we need to instill the trust in not just the kind of champion, but how do they instill that down into the rest of the company to make sure that buying decision is really smooth and logical and appropriate for their business at that stage.
You mentioned something in our earlier conversation, speaking of challenges that stuck with me, building brand trust without the CEO physically on the ground in Canada. In a sector where trust is literally everything, how do you compensate for that?
You build trust from paying off the promise that you're making. Jason, like I think that it's what you do every day. We say we pay claims fast. We do it. We say that we have really fast employee response to issues for customer service. We respond really quickly. We focus on every single renewal because we can. That right now, this is the scale that we're at. So I mean, trust. Yes, it's obviously nice to have a CEO on the ground to be able to forge connections and use that network. But trust isn't built through just having a CEO on the ground. Trust is built through the way in which you show up every day for your customers and for prospects and for the way you execute. So I don't necessarily think it's about titles. It's about just delivering on what you said you're going to do every day.
Your sweet spot, you've said, is kind of companies with about 10, 20 to 100 employees. Why that segment, and what makes the smaller companies more open to a challenger brand like Allen?
Yeah. They are the ones, Jason, that feel the most friction that we have found. They are often the ones who are too big to be managing benefits manually. They are too big in the sense of like the scope of the founders and or HR people being able to do that it just is out of scope for them. And they're also kind of too small to get real strong attention from. Obviously, they have broker relationships, and this is not at all to besmirch brokers, and they're hardworking, honest Canadians. But I think that they're caught in a situation where a lot of the carriers, unless you are a large volume play, it's hard. So they're not able to kind of necessarily give them the attention they deserve. The HR person is the one who's doing everything. Founders are still involved in those decisions. And I think that the kind of secondary part to that is like, these are businesses that we have found, especially within subsectors around services and tech, white collar, like these are businesses at this stage that are really focused on culture and employee experience. They matter more. They want to be able to make sure that they can showcase to their, employees that they're recruiting, team members that they're trying to retain, that, we actually give a damn about you and your long-term health and success. And that makes them more open to this new model. So we have found the most success in this pocket right now.
Fish where the fish are and where they're biting, I guess. And I think knowing who you could do a great job for is super important. You're also backed by this kind of parent company in Europe that's valued at, I think, 5 billion plus euros, with over 700,000 members across Europe. You could build a huge marketing team in the market and attempt to get market share really fast. You could decide, okay, we're going to go up market to these bigger employers that have lots more members. Like, there's a lot of things you could do. You've chosen a strategy that's quite antithetical to that growth at all costs approach. Explain why.
To be very forthright, Jason, we tried the non-slow, warm approach, and it came back to bite us. We spent lots of our budget on trying to scale this business really quickly to ride on the coattails of, we are so successful in Europe. Obviously, everyone's going to want to talk to us. We tried that, and it did not work. We did not able to get any sort of traction in that approach. So the warm approach was a strategic pivot for us to be able to say, we are not going to try and sell to everybody. We're going to try and find the right fish to go after, the right ponds to fish in, as you said before. But we're going to do it in a way that is going to enhance the probability of success. And how do you enhance the probability of success? You find ways to build trust and credibility. And trust and credibility comes in a few different ways. We have kind of had pillars or tent poles around building trust and credibility, whether it's hosting events, finding ways into organic media, being able to find partners to run events with or to partner on initiatives with. Those are the things that, when you think about the warmth, is you're going to get somebody coming through who has heard about a tier one publication or a top notch brand out there that we've tried put ourselves next to, and that's going to give us the warmth. It's the kind of the radiation from them warms kind of it by proxy, gives us the same warmth, and then we're able to have more rich, more productive conversations with prospects.
How do you lean on Allen's European track record and financials to build credibility when nobody in Canada has heard of you? Or maybe do you? And if not, what has been, aside from leaning on the product and saying like, hey, we're better, and then proving it, how are you building that credibility?
It's a delicate balance, Jason. And that's a really good question, because the balance and the art of that is very dependent on the customer and prospect that we're speaking to. Like whatever conversation we're going into, whatever piece of content we're developing, it's a fine balance, and we have to walk that line. How do we use the European reputation to build that credibility? We use it in a way to help really suggest that we are a company with good capital requirements, good infrastructure. We have longevity and proven success in other markets. But when you are talking about being able to service the business in Canada, like Canadians, they want to buy from employers, they want to know how it works here. They want to know how the local underwriting works here. They want to make sure that it's local service, local support. They want to make sure that, you know, while we're getting, credibility and saying that we're not going to go insolvent overnight, that we're, going to be a 100-year company in this market, that we're going to continue to invest in this market, they still want to know, well, what does it mean to be operating in Canada? And that's where you kind of have to toe the line or walk that line between leaning too much on Europe's success versus telling the Canadian story that is important and resonates with the market here.
Let's talk about the product gap. The Canadian product is a simpler version of what you offer in France, Spain, and Belgium. How do you manage that tension between the vision that you're selling and what you can deliver today? And, obviously Canadian kind of employees and members are not comparing it to the European plans that they don't have access to. But as you think about the product promises and what you're trying to build in Canada and the roadmap, comparing to your competitors there, how does that play out?
We face it as head on as we can, Jason. I think that there's obviously, edge cases where there are businesses that have outposts from France and their, French counterparts are like, wow, we have Alan here. We'd love to get it in Canada. And it's you know, for lack of better words, a diluted experience here right now. So those are kind of the edge cases. But I would say for the most part, managing that gap is really about facing it head on. It's like being very direct about here's what we have. The conversation, every demo, every kind of piece of content that we have, going outward and is customer facing, we try to make sure that we're not selling the roadmap too much. We obviously want to give them a vision into the future, but at the same time, we're selling the right now to say, here's what we can do for you right now. Because the core insurance that we offer, the core insurance product we offer is quite strong. It's going to, and in that market context, we compete really well. It's when you get into things like health services and prevention, where those are not at the same maturity as our European offerings are right now. I think the benefit right now is that even the idea of putting health services and prevention into a core insurance offering, as in the mindset of a lot of our buyers, is novel enough. So being able to kind of give that, kind of carrot right now and say, this is only the starting point is really nice.
What's really fascinating about what you're doing with Alan is you're tackling multiple constraints simultaneously. So as you think about the single hardest growth constraint that you're facing, is it that product maturity, or is it brand awareness, or is it regulatory friction, or is it something else? Like, what's the big rock, as the traction EOS people say? What are you facing as a constraint that is the hardest thing?
I mean, for me, in my kind of vantage point, trust and being able to get the trust is the toughest thing, because we are a challenger with incumbents that have strong, deep roots in this country. One, and trust because we're asking companies to do something or to buy insurance in a way that they haven't done in the past. So, Jason, in Canada, outside of Alan, the only way to buy group benefits is through a broker. And that's not a bad thing. That's just a difference in the way in which people need to think about making purchase decisions. While we believe what we do is we have conviction that it's a better way, a faster way, a simpler way. It can often be seen as a barrier, because they're seeing as, oh, we need to go through the company in order to do this, as opposed to my broker, who's I trust to be able to give me, and that I am paying to be able to give me the consolidated, synthesized amount of information, so I don't have to spend more time educating myself on what I'm signing up for. So I get that. So I would say it's the trust and the way in which people are conditioned and have historically purchased this product in the past is definitely a growth constraint.
You told me that you're already fielding interest from companies that are too big for the current product. How do you say no to revenue you're not ready for? That's not a question I've asked before.
We actually took that warm first approach, and we're very successful at garnering interest from businesses that were just too big for us. And too big for us means that we don't have the type of tailored solution or the adjacent insurance offerings, whether it's a specialized health spending account, or if it's a flexible benefit. We're just not at that stage yet. But that's great for businesses of that size. And we don't want this to be something that we go down that road and they spend a bunch of time trying to make it work for them, and we spend a bunch of time on trying to sell them on something that we know is not going to work in the long term, that like ultimately ends up in a bad renewal cycle. It hurts the reputation. We lose deals. Like we will get there, but not by rushing to get there. It's part of like, the discipline is actually what's going to build the trust, that we're going to say, it's not a no, it's just not yet. And that's it's a hard thing, but a necessary thing to do, especially when you have, really interested parties that are hearing really good things about you. And you tell that story about being, a challenger and a neo offering in a space that hasn't had this before. But you also need to be like realistic as to what can work right now.
How do you balance growth execution with trust building in a category where one misstep can be fatal?
It's a great question, because you always want to run super fast and make sure that you are delivering on the next new exciting thing, but you always have to choose trust over speed. So we talk about paying claims fast, like that is, core to what we offer. You pay that claim, even if it's manual, you pay it fast, because that's going to make sure we have trust. We fix our mistakes quickly. You don't promise what you don't have. Like you can't overpromise. And this is, as kind of stereotypical as it sounds in, these go-to-market organizations. But you don't promise what you don't have, and you don't take customers that you can't serve well. It's your reputation is what's going to help balance your growth, and making sure that these bad stories, they will outweigh 10 good stories, and you make sure that those don't come, they don't happen. Reputation compounds slower than revenue, and you need to be mindful of that.
Yeah. All right. This is my favorite part of the show, lightning round. So quick questions, quick answers. First thing you'd do if you had to launch Alan in a new country tomorrow, zero brand awareness.
I would find like the best like adjacent neo tech brand out there and saddle yourself up to them, because if you can get the runoff effect from another well-loved, well-recognized brand in your market, it will pay dividends and it compounds.
One metric you watch every week to know if trust is building.
Can I give you two, Jason?
Yes, you may. Yes, please.
Branded search and volume from AI search and GEO.
Love it. Best piece of advice you got about entering a market where incumbents own everything.
Give customers one simple reason to switch. Don't boil the ocean.
Hardest no you've had to say to a potential customer, and did it pay off?
Hardest no was to a business that was well above our ICP right now. It has paid off because we would not have been able to service them. It saved hours of diligence time on both ends.
One tool or resource that's been disproportionately useful in the Canadian launch.
As old-timey as this sounds, it's events. It's in-person moments.
All right. Last lightning question, fill in the blank. The biggest myth about competing with an oligopoly is
that you can't do it.
Nice. All right. This is my last question. It's not a lightning round. You may take your time. If a founder is listening and they're entering any market that's dominated by entrenched incumbents, and probably just a few of them like you're dealing with, doesn't have to be insurance. What's the principle, maybe one principle from your experience that really would help them, that they should carry with them?
These are slow, often laggard markets. That doesn't mean, though, that features are going to win the day. Yes, you need to have the features, but trust is the moat. Build that trust in your markets. Trust comes from execution, and take advantage of your speed to gain that trust.
Jacob, this has been fantastic. Where can people find you online, and what should they reach out to you about?
Yeah, you can find me on LinkedIn. Reach out to me there. You can come visit Alan, learn more about us at alan.ca.
This was sharp and specific. Thank you for coming on and giving founders a really good look at what it takes to break into a market that hasn't moved in decades. Thanks for being here.
Thank you, Jason. Appreciate it.
That was Jacob Batist, and a real look at what it takes to break into a market that hasn't moved in almost 70 years. If you remember nothing else from today, remember these top 3 takeaways. 1, trust is the moat, not features. Jacob said it plainly. These are slow, laggard markets, and features alone will not win the day. The hardest growth constraint Alan faces isn't product maturity or regulatory friction, it's trust. They're asking employers to buy insurance in a way they've never bought it before, without a broker, from a company they've never heard of. That only works if every interaction earns credibility. Trust comes from execution, and reputation compounds slower than revenue. 2. The warm first approach wasn't their plan A. It was a strategic pivot after blitzing failed. Allen tried the fast route first. They spent budget trying to scale quickly on the strength of their European success, and it didn't work. The warm approach, events, organic media, partnering with credible brands for the radiation effect, came from learning that in a trust-dependent market, you can't brute force adoption. You have to earn the right conversations before you can close them. And 3, saying no to revenue you're not ready for is a growth strategy. Jacob's team is already fielding interest from companies too large for their current product. They say no anyway, because servicing a customer poorly leads to bad renewal cycles, damaged reputation, and lost deals downstream. As Jacob put it, it's not a no, it's a not yet. That discipline is what protects the trust that they're building. All right, here's one thing you can do this week that takes 10 minutes or less. Look at your current pipeline and find one deal that's outside your sweet spot. Too big, too complex, or requiring something you can't fully deliver today. Write down what happens if you close it and underdeliver versus what happens if you say, not yet. If the downside risk to your reputation outweighs the revenue, have the conversation this week. That's Frank Growth. If this gave you something you can use this week, follow the show and share it with an operator or founder who needs it. I'm Jason Shafton from Winston Francois. We help companies build sustainable, repeatable growth with a proven operating system. Show notes and takeaways are in the description. Be frank and keep growing.